Good morning and welcome to the Big O Money Show. Andrew Galvin here filling in for Bill Altman, but I'm not, Bill Altman's gone, but I do have another Bill with me today, Bill Kizer.
Andrew, great to be here
Yeah.
today.
And then obviously all-time trusty co-host, Tony Shore. Tony, how you doing?
Good. When I heard Bill Altman wasn't going to be on the show today, I started to get a little weepy, a little sad. And then you told me Kizer's going to be on. I'm like, we've got a Bill, and I'm happy. I love doing the show with Bill Kizer.
I always have a Bill around the Big O Money Show.
I love it. Now, Bill Altman isn't here today, and for our listeners and viewers out there, Bill has family in town.
Yes.
So he's playing host today, and he's got a wedding coming up. He's doing some planning. But you mentioned he may golf this afternoon.
Mhm.
And when we were talking about Bill Altman's golf game, we came up with a tragedy plus time equals comedy. And that basically sums up Bill Altman's
Well, that's
golf
what
game.
we thought of when we thought of golf game.
Have either of you or both of you ever golfed with Bill Altman?
Yeah, a number of times.
Yeah.
Are there a lot of expletives, or what happens out there on the course? I've never golfed with Bill.
We'll get you up here sometime, so and you can experience it firsthand. It's a real treat.
Oh, me on the golf court is a real treat. I mean, I've got quite the form. I slice to the right every time. In fact, I wouldn't even I wouldn't stand on my right hand side if I were you. That's how wicked my slice is.
Okay, so a Jake situation then. I'll make sure not to stand there.
Jake, does Jake slice? He's not a good golfer.
Well, that's who broke my hand.
Oh no! Oh my goodness, that's a story. I don't think I've ever heard that story.
Yeah, when I was splinted up earlier this year,
Yeah?
Tony. Yeah, that was Jake that did me in. So I gotta be a
Wow,
little careful.
wow! And you didn't have him fired immediately? He still works there?
I figured everyone deserves, a second chance, and he hasn't
Wow.
broken another finger. So I think he learned his lesson.
I think we'll golf with Jake again. So Jake's a good golfer.
Yeah.
You know, he's a lot of fun to golf with.
Yeah. He's
Unless he breaks your hand. I don't think
No.
Andrew's going to golf with him anytime soon. The way it
Well,
sounds.
that was tragedy and comedy.
and it's
as well.
been enough
Yeah.
time
That was
now.
Yeah,
now,
it's been enough
now
time.
We're laughing about it right
Yeah.
now. So
Yeah, they say comedy. There is no comedy without cruelty. I don't know about that, but I do know that tragedy plus time does equal comedy.
Yes.
I mean that's the entire premise of America's Funniest Home Videos, or half the videos you see online these days, the
Right.
reels.
I love those compilations of people just, jumping off a trampoline and wiping out.
Oh, the trampoline ones are those trampolines are brutal. I don't know how they're not illegal. It's like lawn darts, the old lawn darts that had the steel
The actual
points. When I was a kid, we had lawn darts and they had sharp steel points, and you just throw them way up in the air as kids. I can't believe no one was killed, and those are illegal now. They can't even make those the way they used to. I'm surprised they're able to just make those trampolines. You see so many people get hurt on those, but at any rate, but yet parents still buy them, throw them in the backyard, shove the kids out the door, and
if you're like
you
a
kids go
5-year-old,
out there and play.
your parents have a trampoline in the backyard. I mean, you are the most popular kid on the block.
Well, yeah, your friends come over, and then as a parent, the parents are looking out going, how's our liability insurance?
Bill Kizer looks like he has a story here.
Not a chance. No,
A trampoline at the Kizer household.
we would never do that. So,
Yeah. Well, we better jump into it. We've got finances to
Yeah.
talk about. Let's hit the market update. What's going on with the markets? Andrew, I assume you're going to talk to us about that.
Well, just briefly, Tony, and I think obviously Bill Kizer can speak to this too, but the last week has been really, really solid in the markets. And it's kind of been interesting, the market seems to be looking past a lot of these headwinds that we're seeing. The Iran stuff, the oil prices, and they keep saying hurt's coming for the economy. I keep seeing those headlines. I don't know if you guys have been seeing those too, or maybe some of our listeners have, but at this point, stock prices and indexes have been incredibly resilient. And we actually hit new all-time highs at least twice this week, going into the end of the week. And it kind of looks like that might continue. Obviously, no crystal ball here, but I just think it's been a pleasant surprise, especially with everything that's kind of been going on in the background.
Yeah.
So,
well, and some of those things too are some of the downward pressure on the interest rates as well. And obviously we don't have a new Fed chair quite yet, but
not quite yet.
But that's the word, and maybe some of that's been being priced in.
I think
to the
so.
Market
I absolutely think so. Yeah, because they're talking at least 2 rate cuts, I think, is the forecast for the end of the year. So that means Fed funds rate would be 3%, because we're at 3.25 to 3.5 right now. So that would be good, for markets. It would be good for homeowners, first-time homeowners, or maybe people that want to refinance that have bought in the last couple of years. It might not be so great for fixed income, for retirees that are used to getting the last couple of years a little bit of money from CDs, checking, savings, money market. It's going to be a little bit harder on the yield side to get money from safe options, at least in that category. We're talking about checking, savings, money market, but there are other options out there. Obviously, fixed index annuities, maybe some high yield bonds. Those things are still going to remain attractive through the end of the year. We feel, unless something crazy happens, which it could. They're talking about this new virus out there on the ship by Africa now. Hantavirus. So who knows, right? There's always something on the horizon.
There is. I mean, from the Strait of Hormuz to luxury cruise ships in the Arctic with disease, you can't get around it. But when you talk about the markets and the Fed lowering rates and that helping the market, there is the chance, though, if things don't get resolved or continue to stay bad with oil, if oil prices go back up, or if they don't get back down to, like, say 80 or below, if they stay high, that might prevent those Fed decreases in the interest rate, and that will negatively affect the market. And that is a possibility, isn't it, Andrew? Bruce? Or Bill? Bruce. I call Bill Bruce. It's a B word. I'm trying to distinguish him from Altman somehow.
Mr. Kizer, yeah.
Yeah.
But no, I think that's a good point, Tony. I mean, conceivably, the conflict drags on and we end up in a situation where we're not able to lower those rates. Would that be a disaster for the market? I don't think so. I don't think it would provide as much buoyancy to the market,
right.
As we go through the end of the year. But the worst case scenario is if things really start tanking or the economy gets too hot, and they end up having to go the other way. That's really, I think, when, we'd see worst case scenario is those interest rates going up. But I don't think we're in that situation. So, to your point, Tony, could we have a neutral, rate through the end of the year where there's no cuts? Could be. We'll just have to wait and see.
Nobody has a crystal ball. Well, Bill Kizer, Mr. Kizer, you might have a crystal ball. What do you think?
Well, it's hard to see. I mean, it seems like they are pricing in, interest rates cuts right now.
Yeah.
I think it would have to be a pretty dramatic chain of events on the news side to have things, for the interest rates to
stay the same.
Thank you.
Yeah. I mean, it would have to, if oil prices stay high or continue to rise, then we could start to see inflation creep up, because oil affects if oil is expensive, that affects the cost of everything, because everything is shipped. And so much is based on petroleum based as far as manufacturing. So,
and it is interesting on the oil side too, where one way that the oil prices have been staying up is the presence of OPEC, and OPEC's, I think they're, the UAE just dropped out of
OPEC,
OPEC here,
which is
recently.
huge. Yeah.
It's a big deal.
So it will be interesting to see how that plays out. But I agree. I think right now the conventional wisdom is, or a lot of people are saying, we may see one or two rate cuts again by the end of the year, and that would, the markets, though, regardless of the rate cuts or if it stays the same, our market I'm shocked, even with everything going on in global economics and the Iran war and oil, our markets have been resilient. I mean, we're still up for the year.
And corporate earnings are up about 18-19% so far this
Which
year.
is huge. And that's what the market's based on, is corporate earnings, really, when you get down to the nitty gritty, right?
Earnings drive stocks, which drive the economy, and it's a cyclical cycle. I mean, so if you start to see that earnings are coming in lower, than forecasted, or even could potentially drop negative, they call that a lagging indicator. So at that point, you'd be like, oh yeah, obviously we're in some sort of a recession, right? But at this point, that has not been the case across the board. Basically 75-80% of companies have continued to raise their revenue forecast for the year. And it's been interesting. I don't think anybody would have expected that, with the first couple weeks of that strait being closed, oil prices went haywire. I do think, however, Tony and Bill, we will continue to see volatility. And so we go back to some of those things that Bill talks about all the time on this show. How do you protect yourself?
Right.
What can you do against that volatility? Well, we need to make sure we've got a plan. We're staying invested according to that plan. And that's incredibly important, whether we're at all-time highs in the market or whether we're at a 20% pullback in the market. So that's my 2 cents on it.
That's good. That's a good take. And I think it's important for our listeners to understand this. I'm glad you're giving us an update on where things stand. And I know you guys stay on top of it, and you're partnered with investment firms that actively manage these accounts. They're actively managed, and you can pick up the phone, talk to senior portfolio managers for your clients. And I love the fact that your clients' investments are actively managed, and you're staying on top of everything that's going on, so your clients can sleep well at night. They don't need to worry about market volatility, right?
Yeah. And it's interesting because I think Bill said this several times on the radio, and Mr. Kizer, you've heard us talk about it. And Tony, I know you have too. When things start to get volatile, it's almost like people call and have questions. I'm not saying they never call and never have questions, but we almost kind of, when we onboard them, train them not to look at things or expect that the market is going to be volatile sometimes. And we don't panic. We don't sell out of the market when things drop, right? Because if we're doing that, then we're not allocated correctly in the first place, and we need to come back and have that conversation. So if somebody's listening today and they're saying, well, I don't know how I should be allocated in this market, feel free to pick up the phone, give us a call, talk to Justine, get on our schedule, 402-557-6730, right here in Omaha, the Big O Money Show, coming at you live from Premier Studios. And with that, I'd like to transition to another topic, Bill, that I think is pretty timely. We actually have had several discussions about it this week.
Yeah, it's really interesting. Often we'll meet folks who have been, they talk to some other advisors, of course.
Sure.
And,
town.
kind of a popular, there are a few, yes. Just recently we had a lady who came in, and she was advised, and she was asking us, Bill, I really need your help. I need your team's help, as to, I have a 401k, and her income, I think, was, she's retired, as well, about 69, 70 years old or so. Yeah. And she was being advised to convert a large portion of her 401k, into a Roth IRA.
The old Roth conversion tactic. I love it.
Yeah. And it's, and just as a reminder, a Roth is where once you convert to it, then everything can be your assets can be accessed on a after-tax
Basically a
basis.
tax-free schedule.
Yeah, tax-free schedule.
Yeah.
So,
because you prepay the taxes when the money's going into the Roth. And whether you convert it, whether you contribute it, doesn't matter. You have to prepay before any of those dollars go into that Roth.
and this lady was also faced with, knowing that, at age 73, that she would have to take required minimum distributions out of her 401k.
Yep.
And so when she would do that, she was looking at having considerably higher income that she'd have to recognize. And then when the government says, look, if you make too much money, we're going to charge you a premium or an additional fee on top of your Medicare premium.
Mm-hmm.
The standard
Medicare that premium right now?
Yeah, the standard premium is $202.90. That's the Part B premium. And when you get charged more, that they call that an IRMAA or income related. It's boy, Tony, it's like it's jargon, as well, but it's income related monthly adjustment amount. But the increase, in her situation, she was, she would have gone up from a $202.90 a month to $405 roughly. And but the bottom line is that she was really concerned about having to, when you convert money out of your IRA into a Roth IRA, you got to pay the taxes, the federal and the state taxes. And she was having to, theoretically, stroke a pretty big check, as well.
Yeah.
And I think, kind of looking at the numbers, it didn't make sense, right away to do that. I think there are definitely some advantages, to going to a Roth IRA, but it didn't necessarily make sense.
Well, and what did the other advisor say? Because I think that was an interesting point. He was saying you should do this conversion. And they were talking a sizable chunk of money. They're talking $250,000 for 3 years.
Right.
And when you do that, potentially
only broken up into 3 years. And that's a large amount. Those are huge tax hits each of those years.
Every single year. And so,
and how old is this person?
She's 69.
Oh, wow. Okay.
Yeah, this would have been.
I mean, Roth conversions are such a hot topic right now.
Yeah.
I mean, I'm hearing this from so many people. It's like I've talked to a lot of people in the financial world over the last month or two, and this is like the hottest topic. And so many people are being hit up with this. And there's some advisors that they tell everyone you got to do a Roth conversion. Everybody
now. Yeah.
But what were you going to say, Bill Kizer?
It would have been roughly at those numbers. That's the amount of taxes that you'd have to pay is somewhere between $270,000 and $280,000 over the course of those 3 years, and so that's a lot of money.
That's a huge chunk of change.
As well. So,
and it would not get rid of her RMDs at 73. By the way, so she would pay all this money in to try and prepay taxes.
Right.
She would still be in the first layer of IRMAA, and she would have RMD income at age 73.
Even if she converted it into a Roth, but there's no RMDs with a Roth.
Because it wasn't a full conversion. So those $250,000 chunks over 3 years were not the whole thing.
Oh, wow. Okay. So she still had a large sum that would have stayed in a traditional account, tax deferred account. So those monies, when it would have required withdrawals, that would have been then taxed and still pushed her in a higher tax bracket.
Yeah. So in fact, the savings on the IRMAA, when she between doing the Roth conversion and then not doing it, it is about $1,500 a year.
Yeah,
is what it would have been. Wow. So you write a big check, for $270,000, $280,000 over 3 years for savings of about $1,500 a year.
Yeah, I'm so glad you brought this up, Bill Kizer. I've said this before, Tony, and I'm going to say it again right now. the worst thing we do as financial advisors sometimes is lump everyone into the same category and do an absolute. So the Roth conversion, in my mind, is one of those things where you hear that as a boilerplate, have to do it. You need to do a Roth conversion because you will pay less in taxes. And I don't necessarily think in this situation, Bill Kizer,
Right. Right.
I don't think that's true.
No, I think the time horizon is the longevity and time horizon is working against her. So, at a certain age, depending on how much you have and where your other monies are at, Roths can be the best thing in the world, Roth
Agreed.
conversions.
Agreed.
But boy, if you have a financial advisor just telling you got to do a Roth conversion and you're at that age and you're still going to have to pay huge taxes, you got to have somebody that's looking out for your best interests and doing the math like you guys are for them.
Yeah. And Bill Kizer did a tremendous amount of legwork for this client. I mean, it was honestly impressive because, he came in and told us about it and, and then crunched the numbers. And, I think we all agreed, Bill, that probably that's a no-go.
Yeah.
Well, and I think by the same token, it does depend on, like in her situation. I mean, her income level was it was lower, but we had some other clients here recently where we ran the numbers. Their income, they were getting a lot of income from other businesses and other sources as well, and they were already in a higher income tax bracket, and it made sense, to do that as well.
Sure. Tax brackets. The two things that matter there are the tax brackets. You don't want to bump up into a higher tax bracket. And I know you guys look at the math, figure it out where they're at to make sure, okay, we can bump up against it. So you have some room there maybe, but you don't want to go over it because of IRMAA. And I like to call her Aunt Irma. You've got Aunt Irma and Uncle Sam. Uncle Sam is the taxes from the tax deferred account or the taxes you're going to pay when you convert to a Roth. And Aunt Irma, these aren't your good, fun aunt and uncle. This is the mean aunt.
Strict ones.
Everybody might have a mean aunt who's too strict or mean. And just to clarify for our listeners, Irma people think that the Medicare Part B premium, it's $202 and some cents for this year. And they think everybody pays that for Medicare Part B. It went up this year to that. That's what everyone pays. No. If you make too much money or withdraw a chunk of money or pay that have taxable income from a Roth conversion or from your withdrawals from your traditional accounts, you're going to have to pay more, up to over $600. It can go up to over $600 that you pay. And that's a lot of money over the course of time.
Yeah,
right.
It's $400 a month.
And that's what IRMAA is, the surcharge. I'm putting it in air quotes. It's really a tax, but it's a surcharge on your Part B premiums, and it makes it go up, and it can go up exponentially. Am I right, Bill Kizer? You're the Medicare expert here.
Right on. And they're always looking at your income from 2 years ago, in this situation. So if in this, going back to our example, if she made this change or with this Roth conversion, she actually would have gone on IRMAA earlier than she would have if she just didn't do anything on this.
And the last point I'd make on this is if she just did the RMDs, she'd still be in IRMAA, but she'd be in the first bracket of IRMAA.
Right.
I mean, I don't know. There's just a lot of questions there. And
sure, you've got to look at all these aspects. And a lot of so-called financial planners are just like, let's do a Roth conversion. That's the answer to everything. And it isn't for everyone. You can't, it's like my dad always told me, if all you have is a hammer, everything looks like a nail.
Yeah, that's true.
And if all you have is a hammer, everything looks like a nail. You can't just use one tool. You need to go somewhere where you've got everything under one roof. Tax experts, attorneys, Medicare specialists. I'm not going to name names, Bill Kizer, but I know the premier Medicare specialist in the entire land, Bill Kizer. And that's awesome. So you guys are spot on here. And those taxes, it's and RMDs, required minimum distributions. It really makes a difference, doesn't it?
Yeah, it does. Yeah. So if people are listening today, they're saying, hey, I don't know about Roth conversions. I'd like to learn more. Feel free to give us a call, 402-557-6730. Guys, I think we're out of time.
We are completely out of time. Our YouTube viewers will get a little bonus content this show. It'll have to be edited for the radio show, but thanks, guys. It was a great show. It's like Altman who? This was a great show. No, we miss Bill. Bill Kizer, thank you for being on the show. And Andrew Galvin, our hosts, and listeners and viewers, thanks for tuning in. That does it for today's episode of the Big O Money Show.